Good morning, everybody. Thank you so much for coming out relatively early on a Friday morning by Spanish standards, when I'm sure you've all had an amazing night in Barcelona the night before. So clearly we've got the Titans here. Thank you very much, my panelists, for joining me this morning. It's always a pleasure and a privilege to be joined by thought leaders in the space. And today we're going to be talking about the institutional need for DeFi. As you can see, I am Stephanie. I am from Gemini, which is the regulated custodian and exchange, which was founded by Tyler and Cameron Winklevoss in New York back in 2014. We are a spot exchange and we offer various types of custody. In the US, we also offer staking. Aside from the US offices, we have London, of which I'm the head of the UK. We have Ireland, where we've been passporting into 18 European countries, and we're also live in Singapore. So I will hand over to my panelists also to introduce themselves.
All right. Thanks for having me, guys, and thanks for the introduction. I'm Philipp. I'm the co-founder and CEO of LI.FI. Essentially, the problem we are solving is abstraction, right? We're always talking about account extraction and making things easier for users, but who makes it easier for TradFi? TradFi is facing a multi-chain environment, and there's a huge risk of sunk costs, and it's important for TradFi to stay flexible and adaptive. So for them, we are abstracting away core financial cornerstones, which is DEX and bridge aggregation, relay, and data service aggregation. So we're abstracting away the most important pillars for TradFi to build in that multi-chain environment. MetaMask is one of our clients, is sending 95% of their bridging volume through us, for example. We're around 40 people and around 2 years old.
Good morning, everyone. So I'm Henrik, co-founder and co-CEO of Berlin-based Finoa. We are a qualified custodian and staking provider servicing institutional investors across the globe, investors ranging from crypto VCs investing in token portfolios, hedge funds, family offices. And then on the other side, we work a lot with the actual, what we call the builders in the space, so the actual protocol teams, foundations, running their layer 1, layer 2 protocols, managing their treasury with our solution, and incentivizing their ecosystem. Qualified custodian also means that just as Gemini, we are regulated in Germany as a crypto asset custodian, which of course in the latest discussions also coming from the US with the SEC seems to be one of the next big topics in regulation. We, as of today, provide our customers with the custody layer. We provide them with access to staking. One can probably argue, is staking now part of DeFi or not? I hear all different kinds of opinions here. And for me, the actual DeFi piece, so access to liquidity pools, lending, etc., is something we are now implementing. But obviously, and we're going to get to that, it's something that from a regulatory perspective, when you are a regulated and qualified custodian, definitely creates quite some headaches. So we're happy to discuss how this is going to look like.
Thanks, Henrik. I'm sure most people here are very sophisticated in the world of blockchain and crypto, but just for any beginners out there, can we just touch upon DeFi and what it actually is?
Yeah, of course. I'll keep it short. So essentially, the blockchain allows us to reflect assets, ownership, and value flows. So based on that, within DeFi, we try to mimic and replicate existing financial models and services, right? So the foundation for that are probably stablecoins, where we have just one instance that takes on fiat and issues an asset that is pegged to a fiat currency, like the dollar, most often the dollar so far. And based on that, we can lend that out and maybe get access to another stablecoin, which is maybe pegged to the euro. For that, I'm generating yield. I'm getting interest rate on that. So at the same time, sometimes we want to maybe get access to another asset without changing our portfolio, so we would turn to a lending protocol. So lending and borrowing is a thing. Another thing is an exchange. So sometimes we really want to swap and change our portfolio. So we want to exchange between euro and dollar. So we would go to a decentralized exchange. Again, here someone has to provide liquidity and gets interest rate. And so we find TradFi's biggest business model, interest rate swaps, also on DeFi. So these things are evolving pretty quickly. We are figuring out new financial primitives. We are reinventing certain things, but we also see existing mechanisms like the order book coming back to crypto. So it's very interesting. The space is playing around with existing models, tries out new primitives, and we with DeFi provide greater access to financial services for a greater majority of the population.
Thank you so much. Let's play devil's advocate for a moment, because I'm sure anyone in blockchain will talk about the pros of decentralization. But when it comes to institutions, there's always the counter-argument around centralization. So let's maybe just talk about a little bit the pros and cons and see if we can balance that out a bit for the audience. Henrik, do you want to start us off there?
Yeah, of course, happy to take that. I mean, of course, especially after last year's event, there was a whole discussion about, CeFi is all bad, and CeFi is kind of the counter argument to DeFi. And I think what it really is going to look like is we're going to always see kind of a combination of the two, right? And if we just look at our customer base, which is a lot of regulated institutional investors themselves, and they are just looking for working with a trustworthy counterparty, which often means also a regulated counterparty, and then they want to access the crypto space, right? And I mean, a lot of the early day ideas of crypto, not your keys, not your coins. Of course, I mean, I was early in the space as well, and I get the whole idea, but for an institutional investor who just doesn't want to manage the risk of managing the coins and the keys themselves, that whole argument just doesn't count. They want to get access to the asset class, they want to get access to DeFi and the yield opportunities that you mentioned, Philipp. And for that, they seek the support of a financial service partner that they can work with, right? So obviously what we need to see is a trustworthy industry, centralized or not centralized, that kind of holds up security standards, holds up risk management standards, and just doesn't fall into the holes of FTX or whatnot that we saw last year. So I think that's the truth is somewhere in the middle. What we call ourselves is on-chain CeFi, right? Because I think there's a whole differentiation to be made in the CeFi space as well, because you have a lot of those providers that completely abstract what's actually happening on chain. You can somehow create some yield, somehow get some access to earn products, but you have no idea what's actually happening on chain, right? And for us, we fully segregate everything that we do with each customer, and when the customer does any action with us, you actually see it on chain. You can always go on any blockchain explorer and actually get the verifiability and transparency that blockchain holds, right? So this combination of centralized access, but then have the actual on-chain decentralized transparency, I think that's really where I see the right balance between the two worlds.
Philipp, do you have anything to add to that?
Yeah, I totally agree with you, Henrik. At the same time, like I would say, it is. I have a general bottom line, but let's start with the pros and cons. The pros for me are greater financial inclusion and access to financial services. It can provide more security and transparency. It can provide more autonomy and control to consumers and to businesses. At the same time, it comes with greater risk for hacks and fraud. It comes with less consumer protection and regulatory oversight. So for me, the bottom line is essentially we need to, it's a matter of implementation. It's a matter of context. And before we further progress, we need to find better standardization, better interoperability, and more abstraction for consumers as well as for traditional institutions to onboard the next billions, not only of users, but also in sum of cash, right? So, this is essentially my bottom line. But we are on the right path. It's a very fast-moving space. I think it is foolish to sit out on these developments. It's a learning curve we all have to make, and it's new paradigms that has to be manifested in all kinds of roles, not only in the heads of developers. So get your hands dirty, follow that path, because it is happening, and we see all kinds of financial institutions getting into it. We also see people sitting out, but I think that's risky.
Thanks so much. You're right, it is happening. And I think the people sitting out is very much they're waiting, they're watching. This is now not a binary discussion anymore. It's a question of timing. So we've all been in the industry quite a while. So what have you seen in terms of evolution, in terms of the institutions, the type of institutions who are at least wanting to enter the DeFi space, and why?
I like to differentiate a bit on the institutional side between what we call the crypto native institutional investors and then the not so native institutional investors. And I think On the native side, of course, they're really at the edge of the crypto innovation. I mean, they from day one, when they invest into a proof of stake protocol, they want to get access to staking, access to the inflation mechanism, and generate rewards, right? Whereas when you have a more, let's say, traditional institutional investor that just comes in for the first time into crypto, maybe invests in Bitcoin, Ethereum to get started, the concept of staking is something that they can't really grasp in terms of what's the risk profile of this, what's the counterparty risk, what's the smart contract risk behind it. So there's a lot of education then necessary, and that also explains then very much what the range of potential customers looks like, right? Like that we also serve, and how we can kind of build the product for the actual natives in the space who are kind of 3, 4, maybe 5+ years ahead of the more institutional, traditional institutional investor space, but at the same time, let's say, serve the more risk-averse investor. And I think that's really what we spend a lot of time on to find the right balance. So be very innovative and keep the product attractive to the natives. And that's, I think, I mentioned DeFi as well, because I mean, look at venture capital investors native in crypto. Suddenly a completely illiquid asset class, when you invest in, when you do token-based investments, suddenly is completely liquid, and suddenly you have the possibility to participate in DeFi. So actually, not only wait for the actual principal investment to increase in value, but actually do get access to productivity with your assets in the meanwhile. Participate in liquidity pools, participate in lending protocols. So that's kind of then the edge of venture capital investing in DeFi and crypto 2023, right? Whereas a traditional venture capital investor is just used to sit out until the next liquidity event, which could be 5, 7, 10 years in the future. So striking that balance is what we really observe very narrowly.
Thanks so much. I think it's very interesting from the custodial point of view, and you'll feel this deeply, I'm sure. It's very much about how do we keep those tokens in custody, right? Because a metric for a custodian is AUC, which is the new AUM, assets under custody. So it's about finding the best solution, especially in the institutional space where you have the interoperability to be able to move those tokens around the ecosystem. And this is obviously what you are building, Philipp. So do you want to just talk us through that and how, again, the evolution of the institutions that you are having discussions with and seeing where you think maybe in 2023 there might be further evolution, different types of institutions, not necessarily the crypto natives, but the non-natives, which are obviously the ones we're always trying to convince.
Yeah, of course, thank you. So the custodial market has become much more competitive over the past 2 years. We see these custodians coming out everywhere, and I think, as we just heard on the last panel, is that all the banks are going into custody providers and try to offer these services to their clients. From there on, it's now important to create, to keep AUC as high as possible. But the customers are more and more risk-friendly and are willing to touch base on DeFi products, right? At least getting different asset exposures. And in that process, they are facing a multi-chain environment. So what we do with LI.FI is essentially we would allow, so what's happening is that these users leave custody in order to engage with DeFi if custodians can make that simpler and allow to leave custody, swap into the desired asset, get the asset exposure that's desired, and get back to custody, then custodians can keep their AUM or AUC as high as possible, while giving that desired access to DeFi, while giving the sense of security and mitigating risk that these assets are too long on hot wallets and whatever. We have aggregated all the DEX aggregators and DEXs on all those chains, and even the bridges in between. So we are working closely with custodians nowadays to figuring out in that regulatory environment what is doable, what's not, right? Like this is the only constraint here, to leave custody, find that one particular asset. We have a smart routing algorithm that figures out the best route, the cheapest and safest, and and then send these assets back into the custodian where it comes from. Doesn't matter if it changed the chain or not. But this is one way how we aim to address all of that. And of course, we do a lot of risk assessments. So we just released a risk assessment framework together with Consensus. Over the past 6-7 months, we worked on this. And that allows us to educate our clients and custodians on which risks are there in terms of infrastructure, in terms of asset risks, trust assumptions, and all of that. And the different types of bridges, there are like 5-6 different types. Most people are not even aware of that, which is totally fine. It's a complex space. But we educate on that and then make sure that we have safe pathways to certain assets or protocols. And we even allow things like swap, bridge, swap, and stake within one transaction. So it's very seamless user experience that way. And it allows to get exposure to all kinds of protocols or assets.
Thank you. You mentioned within the regulatory environment, which is always tricky, of course, because there isn't just one regulatory environment. I mean, MiCA is obviously giving a little bit more harmonization across Europe. But I'm just interested to know from both your perspectives. You're both based in Germany, I believe. Germany obviously is, quite at the forefront of blockchain technology and adoption and regulation. Do you see Germany pulling forward and being sort of that center of Europe? I'm sure people in the audience will all have their own opinions of who will reign supreme in Europe when it comes to DeFi or blockchain and crypto in general. Just as a fun question.
I think first of all, that was a bit too much praise for Germany, I think, as a location for blockchain. I mean, we did definitely some good steps forward already early on 2020, actually, when, for example, the concept what you now hear in the US at the SEC as a qualified custodian in crypto was already put in place. That's now 3 years ago, right? So been there, done this in that kind of sense. But I think in what we see as well is that the concept that was put in place, how to kind of fold crypto assets under a given banking act, under a given banking regulation, that this sees a lot of reflection now in regulation across the globe. But I mean, just look at MiCA for the European Commission. I mean, it doesn't even touch DeFi just yet, right? So it's really very stablecoin focused, right? And it would be great if it did touch DeFi, and if it would kind of create clarity on how to treat DeFi, because I mean, you said it in the beginning, it's clear that DeFi is gonna, in one form or another, needs to be provided to institutional investors. Traditional or native crypto, it doesn't really make a difference in the future anymore. It's going to be all crypto native. So as soon as possible, we just need the clarity, how to provide it, how to do it, and off we go, right? And the longer this takes, I think the more it's going to harm the innovation space as well.
Anything to add to that, Philipp?
No, not much. It's for us, it's like I can just tell from common experience, I spend almost no days in Germany these days. I'm just traveling, and that's for a reason. Despite being a German company, we find our business everywhere.
For tax reasons, or
exactly, yeah. Staying in Germany to pay more tax. Yeah, that's the thing. No, South Korea and other countries are much more risk-friendly, trying out new things. But we're coming to an end. So, thank you so much, both of you.
Thank you very much. Being great panelists. Thank you very much to our audience.